Welcome to FXtech's comprehensive USD CAD analysis for November 10th through 15th, 2025. This week marked a critical juncture for the US dollar-Canadian dollar pair as it tested the psychologically significant 1.4000 level for 4 consecutive days. We'll examine the key technical levels, fundamental drivers, and strategic trading opportunities across multiple timeframes. Our analysis draws from 5 leading Forex sources, including TradingView, Investing Live, Action Forex, Forex.com, and Daily Forex. Whether you're a day trader, swing trader, or position trader, this presentation will provide actionable insights to navigate the current market environment. Prepared on November 17, 2025, this report synthesizes the latest market developments, including Canada's surprising employment data and evolving central bank policies. Let's dive into the analysis. USD CAD spent 4 days testing the critical 1.4000 psychological support level, a major inflection point for the pair. On November 15th, the pair traded at 1.40261, showing technical indicators in neutral territory, with oscillators mixed and moving averages signaling a buy. The 1.4000 level represents more than just a round number. It's a key battleground between bulls and bears. A sustained break below this level could trigger a cascade toward 1.3886, while a successful defense might propel prices back toward 1.4139. The market remains in a consolidation phase, with traders awaiting a decisive breakout. Volume patterns suggest indecision, and the tight range between 1.3984 and 1.4080 has compressed volatility. This setup creates both risk and opportunity, depending on your trading style and risk tolerance. On November 8th, Canada shocked markets with an employment report showing 66,600 jobs added, far exceeding forecasts. The unemployment rate dropped from 7.1% to 6.9%, signaling unexpected strength in the Canadian labor market. This data had immediate market impact, pushing USD CAD below the 1.4080 support level. More importantly, it dramatically shifted Bank of Canada rate cut expectations, with the probability of further cuts by end 2026 dropping to just 36%. The BOC recently cut rates by 25 basis points to 2.25%, now at the lower bound of their neutral range. Forward guidance states current policy rate is about the right level, effectively signaling the end of the cutting cycle. However, the door remains open for adjustments if economic conditions deteriorate. This policy stance is CAD positive in the medium term. Despite positive U.S. economic data, the U.S. dollar index weakened to 98.98 Fibonacci support, a technical signal that often indicates a short-term top. Markets are pricing in a 63% probability of a December Fed rate cut, maintaining pressure on the greenback. Key upcoming data releases, NFP and CPI, will have the final say before the next FOMC decision. However, the interest rate differential continues to favor USD structurally. With Canada's policy rate at 2.25% and the Fed maintaining higher rates, traders get paid to hold USD in this pair through positive carry. This differential has remained remarkably consistent despite Fed cuts, as bond markets haven't fully priced in dovishness. This creates a structural floor under USD CAD, supporting the long-term bullish case even as short-term weakness persists. Let's examine the critical support levels that define downside risk. The 1.4000 level is the major psychological support that's been tested for 4 days. This is the line in the sand. Just below, 1.3984 represents the recent low, and a break here would likely target 1.3886. The 50-day exponential moving average at 1.3960 provides rising dynamic support, acting as a safety net for bulls. But the most critical level is 1.3886. This long-term support determines the medium-term bias for the entire pair. As long as this level holds, the bullish case from 1.3538 remains intact. A break below 1.3886 would signal a deeper correction and potentially shift the technical outlook from consolidation to retracement. Traders should watch these levels closely for entry and exit signals. On the upside, resistance levels define potential profit targets. The first hurdle is 1.4039, a minor resistance that, if broken, opens the door to retesting 1.4139. Next comes 1.4068 as an immediate target, followed by 1.4080, which has flipped from support to resistance after being broken. The recent 7-month high at 1.4139 is a major resistance zone. Above that, the 1.4151 to 1.4178 range represents a significant resistance zone that acted as support from November through February. The ultimate target from the inverted head and shoulders pattern is 1.4250, which aligns with the April sell-off point. Action Forex notes, rise from 1.3538 is in favor to continue as long as 1.3886 support holds. This technical framework provides clear roadmaps for both bullish and bearish scenarios. The short-term outlook is mildly bearish with significant uncertainty. The break below 1.4080 support signals short-term weakness, but the 1.4000 level is proving resilient. Investing Live notes that buyers are working on their 6th straight day of gains, though momentum couldn't be sustained above 1.4100. The current price action suggests a consolidation phase rather than a decisive trend. For bulls, patience is key. Wait for a clear break above 1.4039 or a successful defense of 1.4000 before entering long positions. For bears, the entry trigger is a confirmed break below 1.4000, targeting 1.3886. At current levels near 1.4026, the risk-reward is poor for both directions. The next 1 to 2 weeks will be critical in determining whether this consolidation resolves higher or lower. The medium-term outlook suggests range-bound trading between 1.3886 and 1.4312 for the next 1 to 3 months. This consolidation represents a healthy correction within the larger uptrend from 1.2005. The rise from 1.3538 is likely the second leg of a 3-wave corrective structure, meaning a third leg down should follow before the uptrend resumes. This Elliott wave interpretation suggests traders should prepare for extended sideways to lower movement rather than expecting an immediate breakout to new highs. The 1.3886 level is the critical pivot. As long as it holds, the corrective structure remains intact and the long-term bullish case is preserved. A break below would require a reassessment of the wave count and potentially signal a deeper retracement toward the 55-month EMA at 1.3543. The long-term technical picture remains bullish. A golden cross formed in mid-October when the 50-day EMA crossed above the 200-day EMA, a classic bullish signal for longer-term traders. The 50-day EMA now acts as dynamic support near 1.3960, reinforcing the uptrend from the 2021 low at 1.2005. The interest rate differential continues to favor USD, with Canada's policy rate at 2.25%, creating a positive carry for USD holders. This differential has remained stable despite Fed cuts, providing structural support. Beyond rates, fundamental factors favor USD. U.S. oil production of approximately 12 million barrels per day reduces Canada's traditional oil advantage. Canada sends 75 to 80% of its exports to the U.S., creating persistent USD demand. And Canadian budget deficits are forecast to rise, pressuring CAD. These structural factors support the long-term bullish case. From an Elliott wave perspective, the price action from the 1.4791 medium-term top appears to be unfolding as a correction to the major uptrend from 1.2005. The rise from 1.3538 represents the second leg of this correction, and wave theory suggests a third leg should follow before the uptrend resumes. This interpretation aligns with the medium-term range-bound outlook. Additionally, Daily Forex identifies an inverted head and shoulders pattern with a measured move target of 1.4250. This target aligns with the April sell-off point and represents a key resistance zone. The combination of Elliott wave analysis and classical chart patterns provides a coherent technical framework. Expect further consolidation or mild weakness in the near term, followed by eventual resumption of the uptrend toward 1.4250 and potentially higher. Recent price action has been confined between key Fibonacci retracement levels. The 50% retracement at 1.40135 acts as resistance, while the 61.8% retracement at 1.39837 provides support. Investing Live notes that price oscillation between these levels confirms the corrective nature of the current market structure. This tight range reflects the market's indecision and the balance between bullish and bearish forces. Looking at the bigger picture, the 1.4500 level represents a 9-year high water mark and long-term range ceiling. Current prices remain well below this ceiling, providing substantial room for upside within the established range. Forex.com notes minimized expectations for a long-term break above 1.4500. The alternative scenario to watch, a firm break of 1.3886, would revive the case for a larger-scale correction, requiring sustained trading below the 55-month EMA at 1.3543 for confirmation. Let's discuss trading strategies for different styles. Day traders should focus on the 1.3984-1.4135 range, trading oscillations rather than trends. Use tight stops of 10 to 15 pips and take quick exits on momentum shifts. Key intraday levels include 1.4000, 1.40135, 1.40208, and 1.39837. Swing traders have two setups: long between 1.3886, 1.3950, with stops below 1.3850, targeting 1.4200, 1.4250, or short between 1.4139, 1.4178, with stops above 1.4200, targeting 1.3950, 1.3900. Current prices offer poor risk-reward. Wait for range extremes. Position traders should scale into longs between 1.3886, 1.3950, with wide stops below 1.3800, targeting 1.4500 over 3 to 6 months. The rationale? Golden cross, favorable carry, and intact uptrend. Essential risk management. Never risk more than 2% per trade. Always use strict stop losses. Maintain minimum 1 to 1.5 risk-reward ratios. Scale positions at multiple levels, and monitor CPI, NFP, and central bank news closely. In conclusion, USD CAD stands at a critical juncture. The 1.4000 level will determine the next directional move. For bulls, wait for either a firm break above 1.4039 or a successful defense of 1.4000, then target 1.4250. For bears, wait for a confirmed break below 1.4000 to target 1.3886. At current levels, patience is essential. The risk-reward is poor for both directions. The medium-term outlook suggests range trading between 1.3886 and 1.4312 for 1 to 3 months as the third corrective leg unfolds. However, the long-term uptrend from 1.2005 remains intact above 1.3543, supported by the Golden Cross formation and favorable structural factors. Key upcoming catalysts include US NFP and CPI data, which will influence Fed policy expectations. Trade with discipline, use strict risk management, and let the market show its hand before committing capital. Thank you for watching this FXtech analysis. Trade safely and profitably.